Alan Ellman. I know that name.
Hi, John.
Didn't I go on a cruise with you once?
No, but we could set something up.
I just so happen to have an Alaska cruise coming up in a few weeks, and we still have a place. So you're more than welcome to join us. Just bring a heavy coat.
We'll talk about it.
Okay. Go ahead and get your PowerPoint up. Dr. Ellman is president of the Blue Collar Investor Corp and author of best-selling books on covered call writing and selling puts. His fourth book, Stock Investing for Students, is now required reading at several colleges. He also produced several video courses, published hundreds of articles and videos on this subject. Alan has been a frequent guest on financial forums, including this one, such as the Option Industry Council's Wide World of Options and the Money Answers radio program. He is also a national speaker for the Money Show, the Options Industry Council, and the American Association of Individual Investors, as well as an educational contributor to NASDAQ.com. Alan has also completed the Series 65 Investment Advisor Rep requirements. All right, Alan, I see here Blue Collar Investor. Where are you broadcasting from today, Alan?
Delray Beach, Florida.
Good old Delray Beach. Say hi to my grandmother while you're there. Okay, so you know the drill until 5 minutes before the hour, and then we'll hand out our next batch of prizes. I'm going to go ahead and mute myself, and you have the floor.
Thanks, John, and welcome everybody. My topic today is covered call writing, one of my favorite strategies, multiple applications based on current market conditions. In this presentation, I'm going to be using real-life examples with Invesco QQQ Trust, an exchange-traded fund listed on the NASDAQ exchange under the ticker QQQ. Now, one of the reasons back in the mid-1990s that attracted me to covered call writing was the fact that we can craft the strategy to what's going on today. One size does not fit all. So if we're in a bear market, we may handle our trades in a certain way, in a bull market in a different way, in normal market conditions. So in this presentation, which by the way, I've written over 50 webinars on covered call writing and cash secured puts, this is one of my favorites because it will show how you can craft the strategy to your personal risk tolerance, to what's going on in the market today, and your particular trading style. So typically, when I do presentations at the Mad Hedge Summit, Barry Bergman, BCI Managing Director, is in the background responding to your questions in real time in the chat box. But Barry's on a cruise, not to Alaska, but he's on a cruise. So I'm flying solo today, and hopefully I'll have a few minutes at the end of the presentation to respond to any of your questions. So with that being said, I'm going to show you this famous disclaimer slide here. And basically what it says is, even though the slides you're going to see today have all been recently made, at the time that they were made, they were appropriate trades, may or may not be today. So take this information for educational purposes only and not as specific trade recommendations. So what are our strategy goals as we're using this strategy of covered call writing? Well, we're looking to generate monthly or weekly cash flow with low risk, high probability trades. Now, for those of us that are using these strategies, covered call writing, and I'm going to put cash secured puts into that same category, we have low risk tolerance. We have a certain amount of risk because for every person that's looking to beat risk-free returns, you're talking about treasuries, CDs, money markets, things like that. That means, by definition, we're willing to accept a certain amount of risk. This strategy, covered call writing, is low risk. It's not no risk, nor is it high risk. But we're going to figure out ways that we have high probability of success trades. And in this particular case, we're going to leverage the ETF QQQ. It could be done for any stock or any exchange traded fund that has options associated with them. And there are quite a number. And we're going to craft that strategy to align with multiple market conditions. So what are those conditions? Well, first off, and the one that we're going to really be using the most, are normal to bull markets. So a normal market can be defined as a stock market going up 6 to 10% a year, bull market more than that. We're also going to look what happens if we're in the midst of a bear market or perhaps even a volatile market where we want a little additional protection to the downside. So we're going to show you some real life examples using the cues in bear and volatile markets. Now, what if you want to take that defensive posture even further? We're going to show low risk approaches based on your trading style, your personal risk tolerance. What if we're in a low interest rate environment like we were in 22 and you needed basically a magnifying glass to see the interest rate? Matter of fact, in Europe at that time, many countries had negative interest rates. If you wanted to put money into their banks, you had to pay the bank. So what happens if you're in a low interest rate environment and you're looking to generate income, but in a very ultra low risk manner? We'll discuss that as well. Or if you just want to take an extreme defensive posture in return for lower returns when you compare it to traditional covered call writing, if it helps you sleep better at night. So these are the conditions that we'll be looking at in today's presentation. Now let's start off with the basics and define the strategy of covered call writing. This is a low risk, again, not a no risk option selling strategy. So I'm on the sell side of options. I have tried back in the 90s when I started teaching myself these strategies, I tried them all. I did start with covered call writing, which, by the way, I believe strongly that if you're new to options, this is where you should start, covered call writing. You may end up with multi-leg, more involved types of options. That's fine, but this is where you should start. And the reason for that is it's low risk. It's accepted by all brokerages in our government in self-directed IRA accounts, and it's intuitive. People understand covered call writing quicker than most other option strategies. So that is where I believe you should start. Now, the way it works is you first buy, or perhaps you already own, stocks or exchange traded funds in 100 share increments. So in order to sell one option and be covered or protected, you must first own 100 shares of that particular underlying security. Now, once we are covered and we own the shares, we then sell the option, which means we are undertaking the contractual obligation to sell our shares at a price that we determine, that's called the strike price, by a date that we determine, and that's called the expiration date. Most options expire on Fridays at 4 p.m. Eastern Time. Now, in return for undertaking this contractual obligation, we are paid handsomely. And you'll see that with these real life examples that are coming up. Now let's break down the 3 words in the term covered call writing. Covered, that means the stock is purchased first. We know our cost basis. We are protected to some extent. It is a low risk, not a no risk strategy. The second word in the term is call. That's the type of option we are selling. We are undertaking the obligation to sell our shares at the strike price by the expiration date. In return, we receive a cash premium that is generated into our cash brokerage account instantaneously. As soon as we click on our computer keyboard to execute that trade, the cash is in our account. The third word in the term is writing, and that simply means we are initiating a sell to open or STO trade. Now, folks, these are American style options. What that means is the option buyer, that's not us, we're the option sellers. The option buyers can exercise that option and buy our shares at any time from when we sold the option to 4 p.m. Eastern Time on expiration Friday. However, early exercise of our options is extremely, extremely rare. It almost never happens. When it does, it's typically related to an ex-dividend date. If you have any questions on that, if we have time at the end, I'll be happy to respond to that. But the takeaway here is early exercise is extremely rare. So let me summarize for you now. Option buyers, not us, have rights. Option sellers, yep, that's us. We have contractual obligations for which we are handsomely paid. Now, let's define Invesco QQQ Trust, once again listed on the NASDAQ exchange under the ticker QQQ. Well, this is an exchange-traded fund. What's an ETF? It's a basket of stocks. It's like a mutual fund, but it trades like a stock. You can buy and sell it over the course of the day. And many of them, certainly QQQ, have options associated with them. It consists of 100 of the largest non-financial companies listed on the NASDAQ exchange. In the next slide, I will show you the top 10 as of now. Okay, so you'll have an idea when you buy the Qs of what you're actually purchasing. I have found that for more than 2 decades, this has been an outstanding covered call writing candidate, probably the security that I've used the most over the last 25 plus years. That is not to say that it's always in favor and we should always use it. No, but it is frequently in favor, particularly when the tech sector is doing well, which it has been lately. Now, we're going to use a strategy involving the Qs and implied volatility, IV, to generate 10 to 20% annualized high probability returns when we talk about ultra low risk approach. The approach for traditional will be, and for defensive, will be higher returns in terms of our expectations. But when we're looking for ultra low risk, then we're going to be willing to accept lower but still significant returns. Now, let me just mention something here that I try to do in all my presentations. The amount of returns that we're getting, and let's talk from a percentage vantage point now, because you can't talk about dollars unless you know what your investment is. But just from a percentage vantage point, if you're looking to hit a grand slam home run and make huge returns, that means you are willing to accept huge risk. It's as simple as that. The higher the risk, the higher the returns, but the greater the possibility that you're going to lose money as well. The lower the risk, the lower the returns, and the greater your capital preservation goal is. So if we were to set up a risk-reward spectrum, where on the left side you have no risk, let's say treasuries, money markets, things like I mentioned before, and then at the other end of the spectrum, you have extreme risk, like life-changing possibilities from a financial vantage point, like lottery tickets. Well, covered call writing falls to the right, just to the right of no risk. To the right of covered call writing would be buying and selling stocks. Just to the left of the lottery tickets, maybe not immediately to the left, but you have casinos, which are built to make money, not for you to make money, for them to make money. So that just gives you an idea of what we're talking about with risk, ultra low risk, and traditional risk for these strategies. Now, here's the slide that I promised you. If you own 1 share of the Qs, you have a piece of all 10 of these large cap technology companies. Microsoft and Apple are usually 1, 2 in the top 10 for the Qs. But you see NVIDIA, Amazon, Broadcom, Alphabet, Facebook, Tesla, and Costco. Now, you also own 90 other technology companies when you own the Qs. So this gives you an idea when you purchase the Qs of what you're actually owning and why this has done so well for me over the years. Okay, so let's talk now about implied volatility. All right, what is implied volatility? Now, many of you know implied volatility, but there may be a couple of things about it you might not be familiar with. So I want to make sure you have a complete, firm understanding of what IV is. It is a forecast of the stocks or ETF's price movement up or down as implied by the option pricing in the marketplace. So based on the option prices, we can come up with a movement of that security up or down. Now, here's some of the things that some of you may not know about implied volatility. First, it's expressed as an annual percent. So if you're selling a monthly contract on Microsoft and you look at the strike price and see adjacent to it that has implied volatility of 35, that does not mean it's going to go up or down by 35% during that contract. No, what it means is it's going to go up or down 35% over the next year based on the current pricing in the marketplace. So if we want to know what the implied volatility is for that specific contract, it must be converted to using a formula, which I'm going to show you. It's probably going to give you a gigantic headache, but there's going to be a caveat to that. For that specific options contract, I'm going to show you how to do it. It's going to be real easy, even though I'm going to show you the formula, which again is going to require like a half a bottle of Tylenol. Okay, now the IV is based on at-the-money options, so it's easy to look up on an options chain. Now here's another thing that you may not know. The implied volatility is based on one standard deviation. That means that when you get a range based on implied volatility for the movement of that stock, we actually can quantify the movement of that stock or ETF. That means it's expected to fall into that range 68% of the time. But wait a minute, I'm about to tell you that we're going to use IV to create 84% probability of success. Let me use the word approximate, 84% probability of success trades. But yet, I'm telling you, on the other hand, that one standard deviation means that it's expected to fall into that range 68% of the time. So where do I get to 84%? I'm going to show you a graph, and I hope that will basically hammer home why that 84% figure is in fact accurate. Okay, next, we're going to look now at the first scenario, the one that we're going to be using the most, folks, and that is normal to bull markets. So again, a normal to bull market is one that's going up 6 to 10% a year normal, and more than that, bull. Okay, so we're going to sell 1 month out of the money call strikes. That means we're going to agree to sell our shares at a higher price than they're currently trading for. And the advantage of this particular approach is going to create two potential income streams. One, on the option premium. That's money in our pocket that no one can ever take away from us. And the other is from share appreciation from current market value up to that out of the money strike. Now I'm going to show you real life examples, and that'll help make this come alive for those of you that are relatively new to this strategy. And that's why I'm showing you real life examples start to finish on entering our trades. So since we're using an exchange traded fund, not an individual stock, our expectations are going to be for a 1 to 3% 1 month return. That's a reasonable return for an ETF like the triple Qs. If I were using individual stocks, and I've archived this for more than 2 decades now in my articles, in my videos, my live and online presentations, my goal typically for monthlies is 2 to 4% a month. When I'm trading in my mother's account, I go a little more conservative, 1 to 2% a month. Now we have members that go even higher than my 2 to 4% a month. There's nothing wrong with that as long as it aligns with your personal risk tolerance. Once again, one size does not fit all. So when we're selling out of the money call options, we must factor in upside potential, okay, from current market value to that out of the money strike. Now, one of the, I believe, most important guidance that I'm going to give you today is the 20%, 10% buy to close limit orders that will partially automate our exit strategy implementation. Because there are 3 steps to covered call writing, right? We buy the stock, we sell the option, and then we manage our trades, right? So how do we manage our trades? Now that's actually beyond the scope of this 55-minute presentation, but I'm here to tell you, you must know how to do this. And the first step in managing our trades is to set up our 20%, 10% buy to close limit orders. It protects us if the price of the stock goes down. And yes, even if we screen our stocks the way we do in the BCI methodology rigorously, those of you, I know we have many members on board here today, you know that we go through about 12 to 14 screens. It consists of fundamental analysis, technical analysis, and common sense principles like avoiding earnings reports. And even though we rigorously screen the stocks, stock prices can go down. You never know what's going to happen in the market. We're in a global economy now. Nobody can predict with 100% accuracy what's going to happen in the short term. Okay, so we have to be prepared. And the first step of that is the 20%, 10% buy to close, good till canceled limit orders. And I will show you that during the presentation. You'll see real life examples that's actually archived in one of my books. Okay, so remember now, we're in normal to bull markets. We're selling an out of the money call option higher than current market value. Here we go. This is an option chain, and I took this on May 1st, about a month ago, right? And the Qs were trading at 421.82 at the time I made this screenshot. And we're looking at the May 31st. So a 31-day trade, 5/1 to 5/31. And we're going to look at the out of the money, higher than current market value, 424 call strike. And you look in the bid column and you see a bid price of 925. So when you're looking at option chain, for those of you new to options, you sell at the bid, the lower price, you buy at the ask, the higher price. Sometimes when there's a wide spread, you can actually negotiate a better price. But in this case, the spread is only 7 pennies. So there's no need to negotiate. You just set a limit order of 925. Now, I'm about to show you one of the most important spreadsheets available to those of us using covered call writing and selling cash secured puts. This is the Trade Management Calculator, or TMC. It was developed by the Blue Collar Investor. My team and I developed this. Took us about a year and a half. There are over 1,000 formulas inherent in this spreadsheet. Now, I'm showing you a broad overview of this spreadsheet. You're looking down now from planet Mars onto this spreadsheet, because I can't show you with statistics in these cells. You won't be able to read it. So you're only going to be able to see, and I'm going to piggyback the blue cells over the white cells. But at the very end, I'm going to show you all of these break it down in individual slides, because part of the offer we're making at the end is you're going to get the Trade Management Calculator package for free when you purchase our main package. So that'll come at the end. But let me show you now what you're going to be seeing in the slides in today's presentation. In these blue cells over here on the left is where we make our trade entries. You're going to see that on the top lines. Underneath that, you're going to see the white cells where you get your initial calculations per trade and then per portfolio down here. You're also going to see the break-even price points in the middle, and you're going to see your exit strategy price points in the 3 yellow columns at the end. Okay? Now, in the middle section, which you won't see until the end, are our exit strategies. And there are over 20 exit strategies for these two strategies inherent in the spreadsheet. And then the white cells adjacent to that will give you your post-adjusted trades per trade and per portfolio. All the way over to the right, you have your trade journal where you can make entries, notations regarding your trades, and that will all help us when we go back and reevaluate. What did we do that was so great we want to keep doing it? What did we do that we could have improved upon? What did we do wrong? Okay, so that's all part of this spreadsheet. Now, this is the trade that we just showed you before with the Qs. It was trading at 421.82. We looked at the out of the money 424 strike, and we generated 925. Underneath that, and that would be in the white cells I just showed you in the last slide, the spreadsheet will tell us the following. Taken through expiration, it's a 31-day trade. The break-even price point is 412.57, which is 421.82 minus the premium. Now, remember, we're seeking 1 to 3% a month. Here it's 2.19%, which based on a 31-day trade annualizes out to 25.82%. Now we have an opportunity for an additional 0.52% if the Qs move from 421.82 up to the 424 strike. That will give us an additional 0.5%, which means we have the potential for 30%, greater than a 30% annualized return. We would use this once again in normal to bull market environments. And that's when we would use the out of the money call strike. What about our buy to close limit orders, which again, I'll show you how to set those up in the upcoming slide. Well, 20% of 925 is $1.85. We use that in the first half of a monthly contract. And in the last 2 weeks of a monthly contract, or if we're just using weeklies, we use the 10% guideline, which is 93%. Some members want to have some guidelines as to when to just close both legs of the trade if there's share price decline. And that would be 7% is reasonable. That's what Investors Business Daily uses. It's in our spreadsheet at 7%, 392.29. Now, here is a real life example taken both from one of my portfolios in the year 2022. If you have my book, Covered Call Writing, A Streamlined Approach, it's in that book. So let me show you how it works. Let's start off on the left side here. This is the real life trade with the Select Sector Spider and ETF XLP. I purchased on 4/18 300 shares at 78.59, sold the out of the money 80 call at 84 cents. What's 20% of 84 cents? 17. To the right, that threshold was reached. I automated it by setting up a buy to close good until canceled limit order at 17 cents. And it was filled at 17 cents. Well, later on that day, it was a volatile day, the price of the stock went back up. And guess what? I sold that same 80 call at 46 cents. That means that I made an additional $29 per contract, $87 altogether, by using this 20% buy to close limit order. I call that hitting a double in my exit strategy arsenal. Now, once I sold that second option for 46 cents, since we're in the last 2 weeks of the monthly option, I then put a buy to close good until canceled limit order at 5 cents, which is 10% of 46 cents. Now, it may seem a little intimidating initially, but if you do it automatically every time you enter a covered call trade, it really will become second nature and no big deal. Just automatically do it once you enter the covered call trade. Okay, now I want to talk to you about bear and volatile markets. Okay, we're going to sell in the money calls this time. Why? Because it has an intrinsic value component that will give us greater protection to the downside. No change in our time value goal, 1 to 3% a month. If we were doing weeklies, we just divide that by 4. Now we have to factor in downside protection because when we sell in the money call strikes, we are also buying an insurance policy to give us that additional protection. And who pays for that insurance policy? Ladies and gentlemen, this is one of the few insurance policies in existence that we don't have to pay for. It's paid for by the option buyer in the form of intrinsic value. So the intrinsic value protects the time value. I'll show you that when we get to the spreadsheet. We still set our 20%, 10% buy to close, good until canceled limit orders, and here's an example. It was the same date that I created this slide, 5/1. The Qs, you recall, are trading at 421.82. Instead of using a strike higher than that, we use a strike lower than that, 415. And the bid price is $14.70. So for every one contract that we sell, we're going to generate $1,470 into our cash account. Is that all profit? No. Why not? Because we own the shares at 421.82 and we're agreeing to sell it for 415. So we're losing $6.82 on the sale of the stock. The spreadsheet will do this for us. Do not worry. Here's our trade entries, 421, 415 strike, 1470. Our break-even price point goes all the way down to 407.12. Remember, the shares are trading at 82 at the time of the trade. Remember our goal, 1 to 3% a month. Well, it calculates to 1.9% based on a 31-day return, annualizes out to 22.36%. So in a bear or volatile market, I would probably opt for this particular as opposed to the out of the money call strike. Now, if you look at the purple cell all the way to the right, you will see that the downside protection of that 1.9% profit is 1.62%. So we are guaranteed a 1.9% 31-day return as long as share value does not decline by more than 1.62% by expiration Friday. If we were going to take the protection down to the break-even price point, it calculates out to 3.5%. So I think you could see the advantage of using in-the-money strikes in bear and volatile market environments. Our buy to close limit orders would be higher than before. The 7% guideline for when to close both legs is the same. 7% of the price of the stock at the time the trade was entered. Now, let's move on now to the third ultra low risk approach. And here I'm here to tell you that we have an 84 probability of success, approximate, let me add the word right in here, let me get right in there, approximate probability of success. And I'm going to show you a graph in the next slide that will explain this. Okay, when would we use this? When there's few opportunities to generate passive income, as there was in 2022, when we couldn't get any kind of interest rate on any kind of fixed investment. There was nothing. So we could have used this approach. And it's also a great approach if you just sleep better at night, having ultra low risk trades. All right. Again, one size doesn't fit all. I'm not here to tell you how much risk you should be taking. That's your decision to make. We're going to do extremely deep in the money call strikes, and we're actually going to be able to quantify our risk. That's what I love about this strategy approach. We can quantify our risk. And our goal is 10 to 20% annualized, a little bit lower than traditional, but that's the trade-off. To get the additional protection to the downside, to get that, we are trading in some of our potential returns. All right. There is no free lunch in trading. Don't let anybody tell you differently. Okay. Once again, your amount of returns is directly related to the amount of risk you take in your trades. Please, please, please remember that. Okay. And we're going to use implied volatility to establish 84% probability of success trades. Now, I told you before that implied volatility is based on one standard deviation, which means it's going to fall into that range with the brown columns you see right in the middle here. That's one standard deviation. That means it's going to fall outside the range 32% of the time. But of that 32% of the time, 16% is going to be higher and 16% is lower. So let's say when you use an ultra low risk approach where you don't want it to go below that break-even price point by selling the in-the-money strike, your risk factor is just 16%, because if it's 16% on the high side, we're okay. So that's why the risk factor is 16% approximately, meaning that we have approximately an 84% probability of success trade. This is a normal bell curve. I think you can, most of you, or all of you can visualize this, and that's how I came up with the number 84%. Okay, so here's our proposed strategy using the triple Qs and this IV. We're going to determine the expected trading range. Folks, we can quantify the trading range using implied volatility. Is it 100% precise? No, but it's darn close. Okay, so we're gonna get that expected trading range based on the current market pricing over the next 30 days, based on the implied volatility, which was for the at the money strike at that time 20%. Okay, and we're going to use the low end of the range to determine the target premium for selling a deep in the money strike. We want that premium to take us down to the low end of the range. The strike will be much lower than current market value. Now, the time value component of that option must meet our 10 to 20% initial time value return goal range. Okay, what is the risk? 16% approximately. All right, now get the Tylenol, because this is the formula that's inherent in the spreadsheet that I'm going to be showing you in a couple of slides. You don't have to remember this, but I'm putting it up there because I know some of you, like me, love math and maybe a quants. And so the formula that's inherent in the spreadsheet, to get the expected price movement, you take the price of the stock, you multiply it by the at-the-money implied volatility, which I told you was 20%. And here's the tricky part and the Tylenol part. You multiply that by the square root of the number of calendar days until expiration divided by 365. Now, for most of you, you can just forget everything I said in the last 7 seconds because it's in the spreadsheet. Okay, here we go now. This is the fun part, a real-life trade using this IV strategy. The Qs, if you recall, were trading at 421.82. The implied volatility, 20%. It's a 31-day trade. We're going to convert that to the specific contract using that formula I just showed you, a 5.1 to 5.31. We're going to get that expected trading range. We're going to look for that premium. We're going to look on the option chain for a premium that based on the trading range and the amount it's expected to go up or down in a dollar amount. And then we're going to make sure that that particular option will give us our targeted return of 10 to 20% annualized. The trade management calculator will do that latter part for us, but the next shot I'm going to show you is the BCI expected price movement calculator. So the formula I showed you, folks, is inherent in this spreadsheet. You don't see it, it's in the background. Here's how easy it is. All you have to do is enter the ticker symbol, the date you're making the trade and the expiration date, the current price, and the at-the-money implied volatility. That is it. Here's what you get. The spreadsheet tells you it's 31 days until expiration. Based on that formula that's inherent in the spreadsheet, the Qs are expected to move up or down by $24.59. That's going to be our target premium when we look at the option chain. And the range is expected to go from 397.23 to the low to the high of 446.41 for this specific contract, not annualized, okay? And that's all you have to do is make those entries into the white cells. So what we're looking for is an option premium in the neighborhood of 24.59. Well, we look at the 400 deep in the money. Remember, Qs are trading at 421.82. And you could see a bid price of 26.13. We might have also selected 405. This gives us a little more protection. That's what I chose. Okay, so we're going to use the 400 deep in the money call, 26.13. Right now, feed it into the trade management calculator spreadsheet. 421.82, 400 strike, 26.13. Now, of that 26.13, the spreadsheet will tell us only 431 is time value profit. The rest is intrinsic value, protection, downside protection. So we're going to base our return only on the 431. That comes out to 1.08%, and based on a 31-day trade, that annualizes out to 12.69%. Okay, that does come within our 10 to 20% range. Now we have a 5.17% downside protection, which means the Qs can drop by 5.17% by expiration, no more than that, and we still will have achieved a 1.08% 31-day return. Down to break even, we actually have a protection of 6.2%. Now, downside protection simply means the percent of stock price can decline and still retain its full initial time value. Break even price point, that's the price point at which there'll be no gain or no loss. If stock is trading above break even, you have a gain. Below, you have a loss. And once again, the buy to close limit orders are going to be way higher than before because the premium is so much greater because of that additional intrinsic value component. Let's summarize. Covered call writing can be tailored to meet multiple market conditions. I love this strategy, and this is one of the main reasons why. Strike selection and initial time value return goal range is critical to determine your trade construction. We can craft it to what's going on today. Normal to bull markets, bear to volatile markets, ultra defensive. We can create that based on our own personal risk tolerance. I trade differently in my portfolios than I do in my mother's. Just, she doesn't need the kind of income or isn't looking to generate the kind of income that I am. Here's our offer today. And if there's any time left over when I'm done with this, I'll be happy to take any questions. This is the BCI package is our best and most comprehensive investment package. The price is $9.97. It consists of our annual premium membership, which is 13 months of membership. You'll see in the next couple of slides what that looks like. It gives you not only the list of eligible option selling candidates, and we have 4 different watch lists that we offer to our members, but it also is 6 online video courses with downloadable workbooks, 6 spreadsheets developed by the Blue Collar Investor, found nowhere else, 5 of our best-selling books in ebook format, and you save $335.40 from when you purchase this individually. Just go to the bluecollarinvestor.com and click on Best Packages. I'll show you that again at the end. So you have 2 weekly reports, a stock report, which is formulated on the weekends after the market closes on Fridays, and you have a midweek exchange traded fund report, all of eligible option candidates. We also have a monthly blue chip candidate of the best performing Dow 30 stocks, for those of you who just want to do blue chip companies. And we have a quarterly high dividend yield report for those of you who are using the dividend capture strategy. The premium membership also includes over 250 educational videos, and we add a new 1 or 2 every month, and dozens of other files and download resources. Now, of the 18 components of the BCI package, 17 are one-time lifetime charges, okay, and lifetime access. The only one that isn't is the premium membership. So in 13 months, you'll be given the opportunity to renew at $695.40 or not. And if you do renew and your membership remains active, you will never, ever, ever see a rate hike in your premium membership. So here's a list of the online video courses. You could see that they relate to covered call writing and selling cash secured puts, and then covered call writing strategies like portfolio overwriting, the collar where we add a protective put, and the poor man's covered call where we buy a leaps option instead of the stock. And all of these courses, about 2 hours with downloadable workbooks. It also includes the calculators and spreadsheets you see listed on the left. And I highlighted 2 of them, the poor man's covered call calculator. You could see one of the screenshots on the PMCC calculator. There is no other spreadsheet like this for this strategy anywhere. And I also highlighted the stock repair calculator, which is not really an options calculator. It's for those of you who just own stocks that have lost quite a bit of money and you want to lower your break-even price point without adding additional cash to the trade. And that calculator will help you do that using options. Also, we'll get in PDF format our 5 best-selling books. The one you're looking at over here has been #1 on Amazon for covered call writing since 2011. You'd be receiving the 3rd printing of that. We update it every few years. The other one that I have highlighted is Stock Investing for Students, which is not an options book. It's a financial literacy book, which is being used at 4 universities here in the United States. Once again, you get over 250 training videos, including our library of Ask Alan videos where we break down trades either from my portfolio or those shared by members. We have 18 2-hour Blue Hour webinars, detailed webinars, and we add an additional training video each month, sometimes 2. So that's what this package is, our best and most comprehensive investment package. If you purchase that today or tomorrow, I'm going to send you the BCI, the Trade Management Calculator package for free, okay? And the TMC package includes the spreadsheet you saw before. I'll show it to you again. It's 28-page user guide and a PDF of my 8th book, Exit Strategies for Covered Call Writing and Selling Cash Secured Puts. Now, the trade management calculator consists of the 2 spreadsheets I showed you before. The top portion is covered call writing. The lower portion is cash secured puts. And at the bottom, which you didn't see, it consists of 4 tabs. The trade management calculator, of course, its user guide. And then we have 2 worksheet tabs. I won't go into details on those. It's in the user guide, but it's just a way of calculating, making certain calculations before you decide on exit strategies. Once again, this is an overview of the TMC, and it has similar sections for both calls and puts. So this is the put section for trade entries in those blue cells. These are the initial returns. All the way to the right, you see your buy to close limit orders for puts. Your initial calculations for the portfolio. Now, here's the section you didn't see in detail, the exit strategy section, the middle section. You just click on that arrow where you see the red arrow, give you all your exit strategy opportunities. You make your adjustments, and then you will get your post-adjusted returns for both the individual trades and post-adjusted for the entire portfolio. It also includes this capital adjustment section, which I don't have to go into detail now, but if you use more than one exit strategy in the same contract month, it will allow you to get accurate calculations for your total portfolios. That's in the user guide and something that is a must for any spreadsheet like this. It also includes a journal section where you can make notations regarding your trades. The spreadsheet also prints out in a user-friendly manner where you get your initial trade entries calculations and initial portfolio calculations on page 1. On page 2, you have your exit strategy, entries and calculations, capital adjustments, and total portfolio combined post-adjusted results in page 2, and then your trade management journal in page 3, and then 3 similar sections for puts. So it prints out. I don't print it out. I just save it on my computer and name it like TMC 5/19/2024, something like that. Okay, in that TMC package, you also get a PDF of my 8th book, Exit Strategies for Covered Call Writing and Selling Cash Secured Puts, 27 chapters of exit strategy information. Where else are you going to get this information for this strategy? Those 2 strategies, I should say. So once again, here's the offer. It's good today and tomorrow. Purchase the BCI package, that's our main package, and receive the Trade Management Calculator package, a $285 value at no additional charge. Now, this is valid through midnight tomorrow, and you do not need a coupon. Just put in, on the comments section, just put in Mad Hedge, and we'll know to send you the TMC package for free. Go to our website, thebluecollarinvestor.com. Kate is probably putting it in the chat box now, and then click on BCI package. Now, when you do that and you scroll down to the bottom, you're going to see an opportunity to link it up with the TMC package. Do not click where you see the blue arrow. Just click the red arrow, put Mad Hedge in the comments, and we'll send you the TMC package for free. Okay, so once again, here's the offer. And John and Kate, I'm pretty much done. If there are any chat box questions, I can't see them. So if you let me know any questions, if not, I can add a little bit more additional information on some of the information I've given today. What do you got?
Okay, everybody, to take advantage of Alan's offer, the link is on the right in the chat box, thebluecollarinvestor.com. Click on the link, that'll take you to the dedicated sales page, which is available only today. Kate, we have a lot of questions for Alan here. Kate, why don't you go through and read them and let Alan answer?
Sure. Yeah, so one of the questions is asking, how do you handle the DITM call when still DITM is near the XY?
Okay, so if you're selling a deep in the money call option and the strike is still deep in the money as expiration approaches, I guess the question is, if you want to keep the shares, what do you do? if you want to keep the shares, you got to buy back that option before 4 p.m. Eastern time on expiration Friday. And you could roll it out to the next contract cycle. So the answer is buy it back and roll it out. Or if you don't specifically want to retain that particular security as expiration is approaching, then you don't have to do anything. Your shares will be sold at the strike price. You will have realized your initial time value return goal, which would fall into that 10 to 20% annualized range. And so yeah, you have to figure that is an exit strategy. You have to prepare ahead of time. If the numbers don't work out in terms of your calculations, and the spreadsheet will do this for you, then you just allow it to be exercised, and you can move on to a new security in the next contract cycle.
Awesome. And then another question is asking, could you cover the dividend capture program? They came in a bit late.
Yeah, the dividend capture is, there's kind of two ways of incorporating dividends into your covered call writing portfolios. One way is to, let me start with this, Kate. On the ex-dividend date, that's the main reason for early exercise. So if your goal is to generate 3 income streams, one from premium, one from share appreciation if you sold an out-of-the-money call, and one from dividend capture, then what you have to do is not have a call option in place on the ex-dividend date. Okay, now many of these securities that generate dividends, many of them have weekly options associated with them. So let's say hypothetically that the ex-dividend date is in the 3rd week of a monthly contract. What we could do is we could sell options on week 1 and 2, skip week 3, and come back and sell an option on week 4. And this way we've generated still significant monthly premiums and not run the risk of having early exercise due to an ex-dividend date. And that's basically the way to do it. If there are not weeklies, you can always sell a 2-month month option and move the ex-dividend date much earlier than the expiration date of the contract, and it will rarely be exercised. So I know I'm throwing a lot of information out there, but there are definitely ways to manage scenarios incorporating dividends into our income stream. There's also a strategy that I've developed where you could sell a deep in the money leaps option, and that will bring your yield to a much higher return. That's a little bit beyond the scope of this particular presentation, but it is on the website.
Awesome. And then we have another person asking which universities use your book.
University of Maryland, Ramapo College, I believe University of Maine, and one of the Florida universities. And there may be more. Those are the ones that I know of.
Awesome. And then this one seems a little more specific. Someone's asking if we keep the 6 videos, 6 calculated spreadsheets, and the 5 ebooks even after the 13 months expire.
Yeah, 17 components of the 18 are you have lifetime access, is one-time charge. The only one that isn't is the premium membership. And in 13 months from when you purchase the BCI package, 13 months, you will be sent a notice that it's about to renew, and you can accept that renewal and continue or not. And if you accept it and membership remains active, you will see your rate hike.
Awesome. I think that's it for questions. John, if you want to take over for prizes.
Prizes we have lots of. Okay, Alan, thank you very much for joining us. Love having you on every time. You have a very solid following, that's for sure. So we'll see you again in September.
Yes, sir. Looking forward.